investors and traders, and welcome to this week's episode of Technical Tuesday, where today I'm going to be covering the moving average crossover method based on Jim Rohrbach's trading style. And before I get into the charts, let me just say that Jim Rohrbach was a guest that I had many years ago on my PBS television show, Wealth and Wisdom, where at the time he was known to be the Zen of market timers. And so when I was interviewing Jim for the program, I had asked him what was his secret. How did he become the number one stock picker in the world? And he disclosed this method for picking stocks and trading the legs, which are the shorter term trends within a longer term trend, using the charts. Now, before we get into the charts, let me first say that a simple moving average is the most basic of the moving averages. That's the SMA. Sometimes you'll hear about the 5-day, the 10-day, the 20-day, maybe the 50-day or 200-day moving averages. For this strategy, we're using the 20-day moving average, which is basically a calculation taken by the average closing price of a stock over the last 20 days. Now, again, if you're using a 5-period moving average, and you could, that would be more for the day traders. You could even use this on a minute-by-minute chart, or 5-minute chart, 15-minute chart. You pick it. That's what we do. Now, in this example, I'm using Walmart. It's a daily candle chart. And on the chart, you can see that I have this blue line here, which is the 20-period moving average running throughout the price action of the stock. Now, Jim's method was extremely simple. It's one of the most basic strategies that you can follow, especially if you're a brand new trader, where you're looking at the movements of the price action above and below that 20-period moving average. Now, Jim's method was he waited for the price to literally close over that moving average, or he would wait till the end of the day to see if the stock was going to close over that moving average, and then he would take action. So in this instance here, you could see that we have a closing price on the green candle right there, and what happened shortly thereafter? The price continued to run up. Now, back in those days, Jim would buy on a close over the moving average, and then he would wait for a close below the moving average before he would get out. Now, over the years, since having him as a guest on my show, I modified this a bit, where the entry point, if I'm going long, the entry point will be on a close over that moving average. But then I'm looking for signals using my 7-point trading checklist to find weaknesses in that stock, and then I would move to the sidelines, or I would scale out of the position. So I've set up my charts on the Thinkorswim platform to represent Jim's method, and they actually have an up arrow, down arrow feature. Here you can see I have the Jim Rohrbach layout. See right at the top there, I have different layouts, but I use the Jim Rohrbach layout. Now, if we're looking at Walmart again, this is very simple, actually, because the computer is telling you when to get in. All right, so you can see as I magnify that, that is a green up arrow. Why is that green up arrow showing? Well, that's because the price has closed above that 20-period moving average. So if you were buying this stock on that green arrow, this trade is still in force, where you're looking for a sign or signals to show weakness in that upward trend, and then you would exit. Now, on this one, you could see this diagonal line here. That's a target price that I had set for Walmart a few weeks ago. And now that the stock has hit that target price, you could see that we have a red candle showing up right now on lower volume, which is bearish, and the oscillators are starting to move lower, or at least hinge and pivot lower. And so if I got in on that green arrow right there, I would be exiting that trade on a day like today. Back here you can see is another example where the green arrow shows up on this green candle. Interestingly enough, that's a bullish engulfing candle. Go back and listen to some of the other Technical Tuesday videos where I talk about engulfing candles and haramis. And so there is a bullish candle. And what happened thereafter? The stock went from about 97 all the way up to close to 105 in a very short period of time. And you could see that later on, the red arrow showed up once the price had closed below the 20-period moving average. So let's take that modification that I've added onto Jim Rohrbach's method for trading and see how this works. So I would have gotten in here, and I will tell you on that bearish engulfing candle, I would have absolutely taken my profit. Now, some of you are saying, well, why didn't you wait for it to go higher? Well, you don't know. On that day where a bearish engulfing candle is showing up, then that is the get out point. And if you're trying to squeeze out a couple of extra pennies, well, guess what happened just about a week later? Well, that shooting star showed up. And some people may have gotten out on that one. And if the diehard buy and hold until I hit my target prices type of a trader gets in and holds, well, they might have held all the way to the shooting star up here. But what I'm trying to show you is that this method works extremely well for short-term trades, because a lot of times once a stock closes over that moving average or closes below the moving average, it will at least continue in the direction of that cross for at least a little while. And so we're not trying to hit home runs here. We're trying to trade the swings. Let's take a look at another stock, a very popular stock, and that's Netflix, using the layout that I have here on Thinkorswim. Well, as you can see here, this little green arrow is pointing up on the close of that green candle. And what happened? It continued to go up, and it stayed up for a good long time, right up until it started crossing below the moving average here, very close to a bearish engulfing candle with that red arrow. Now, if you were trading and looking for a quick swing, where would you have gotten out here? Well, if I got in on this green candle right here, I may have gotten out on this pivot here, lower high, lower low. You see, so I'm looking to capture a small time frame, maybe a good move, maybe a small move. We don't know what that's going to be like. But remember, when you're getting in, that's a definite signal that's giving you that green arrow. When you're getting out, you don't have all of the data that we're looking at here. You don't know if the stock is going to continue higher or go lower. And so this is a method that works extremely well, and it's something that you could even practice without even putting any money into the market. Now here's another one, HIMS. This is a pretty volatile stock, and I want to show you what could happen at certain times when the stock is going sideways. Now follow me here. Here's an up arrow. The very next day, it went a little bit higher. And then the next day after that, it gapped up big, traded higher, and then closed below that 20-period moving average. So this may have been a very short-term trade. You may have made money on the opening, but if you had held on to the close, you may have lost a little money. You see, so this method works very well when stocks are trending, not so much when they're trading in a sideways trading range. Because if you look here, you would have bought on this candle, sold on that candle, you would have lost a little money. Here you would have bought on that candle, sold on that candle, you would have lost a lot more on that particular trade. Here you would have bought, sold, lost a little bit, bought right back. And if you were trailing your stop on this one, this is a very interesting pattern here, you would have bought on that green candle, bullish harami, traded up. You may have gotten out on that bearish harami, or you may have gotten out on that hanging man, right? Some of you may have been just holding on, waiting for a bigger move, and you may have gotten out on that shooting star. However, like I said before, if you bought on this green candle and held to this red candle, you may have squeaked out with a small profit, maybe even a small loss. So for the Jim Rohrbach method, I like it very much for an entry strategy And then going back to your 7-point trading checklist that we provide for our members at Stickytrades, that works very well for stocks that are going in a sideways range, as long as you're getting in on the arrow, following the technical signals to get out. You see, so that is the 20-period moving average method using Jim Rohrbach's strategy. So I hope you liked this video. If you do, please throw a like down there, add a comment, ask a question. You could subscribe to the channel. That's the best compliment that you can give us, and we thank you so much for that. And you have a good rest of the week, and we'll talk to you on the next Technical Tuesday episode. So long.